Thank you for that. I feel like I now kind of understand opportunity zones. Which, if that's the only thing I come out from this conference, that in of itself will be a win. So, and actually, your last question in particular around stakeholders, which is a really useful segue into our second panel, which if you guys want that coming up, which we are calling the practitioners panel or the Imogen panel, as it will be known. But rarely are there two Imogens in a conference. Well,
I'm the second Imogen.
Yeah, so the point of this panel is really to go a level deeper and talk to and about some of the stakeholders that make up cities, and also explore some of the issues and areas that we think about when we're talking about sustainable cities, because there are so many factors that come into that, from obviously housing, education, prison reform, the environment, all of these different factors, which we need to come together to have, sustainable, thriving cities. So with that in mind, David.
Thank you, and thank you to that first panel for teeing this up in a great way. We're going to get you all energized for discussion now and again after lunch. My name's David Sand. I'm Chief Impact Strategist at Community Capital Management. We're an independent impact manager. We manage a little over $2 billion in fixed income U.S. impact investments. We manage the money with 18 impact themes in mind, many of which touch directly on the notion and the idea of sustainable cities, including transit-oriented development, affordable housing, gender lens strategy that's brought us to High Water Women, and I think this is my third year, and also an arts and culture theme for urban art spaces and cultural institutions, particularly in inner cities. And just to tee up the conversation we're going to have, one of the speakers earlier today talked about the global trend of urbanization and the challenges and opportunities that's happened. And I can't remember how many billions of people who don't currently live in cities globally are going to be living in cities within the next 50 years. What's interesting and I think sets us up well for this discussion is in the United States it's a little different. We had a de-urbanization in my lifetime where the federal government and private industry actively collaborated to move people to the suburbs. We had the interstate highway system, we had federal housing policy that was guided largely by race, and we had what's generally called white flight, where people went to the suburbs. Happy to say that is literally being reversed as we speak by the private sector, by millennials, by the system whereby people want to live in cities. And you've got corporations abandoning suburban headquarters to be in cities. You have millennials who are eager to live in neighborhoods in cities that didn't used to be millennial favorites. And you have the federal government, opportunity zones notwithstanding, we can talk about that later, sort of not doing anything. So really it is a question of private sector solutions for the type of values that we talk about when we talk about impact investing. So clearly, left to its own devices, the capital markets are going to make at least the hot cities in this country completely unaffordable for people lower down on the income scale. And so what we want to do here with our panelists is talk about some solutions. Some are prospective, some are actual. We're going to try to talk in the function, in the context of clients, what sort of solutions clients look for as they come to the various firms and folks that are represented here. So I'm going to let people, we're going to follow Lori's excellent example, introduce themselves, introduce the work that they do, and then move it along to Q&A. So Imogen 2 is going to go first, and then Chloe, Kristen, and Derwin. So take it away.
All right. So I think still good morning, everyone. So not only am I Imogen too, but I also have a foreign accent. So good luck to everyone in the room in understanding everything I say. So I just want to make it very clear up front that I am not from the investment world whatsoever. So I'm not going to use the right terms, etc. And I'm more here to talk about what I think would be an incredibly interesting and important investment for this city. So my job is the advisor of jail reduction strategies at the Open Society Foundations. And I specifically focus on strategies to reduce the jail population here in New York City, such that the Rikers Island jail complex can be closed. I think there's a real role for impact investing at the intersection of closing Rikers, health, and housing, with a real emphasis on housing. But just really quickly, if it's okay, I'd like to, before I go into that, just really quickly have a moment to plug why Rikers, because generally I get the opportunity only to preach to the choir, and I think it's really important at all opportunities to say why we should be closing Rikers and what this should mean. So with the push to close Rikers, the idea is we reduce the jail population from what is now 8,500 to less than 5,000 people, and go from a jail complex that can hold 20,000 people down to one which can only hold 5,000 people. And so why should we do this? So let's really think about what a jail is. So a jail is not a prison. This is not someone who is being convicted of a crime or of a serious crime, that's for sure. That's what we have in prisons. In a jail, we have three main populations. We have people who are detained because they cannot afford to pay bail. We have people who are on violations of their parole, which are things like not making curfew or drinking or smoking marijuana. And we have people who are convicted of low-level misdemeanor offenses. So if we really think of who's in a jail, it's either people who have yet to be convicted of something or people who are serving time for very low-level offenses. And I think a very important statistic is 87.2% are people from Black and brown communities. Almost everyone is poor. Okay, so now I've had my spiel out the way, just something I always feel like I get very angry about when I talk about Rikers, in order for the city to close Rikers Island, we really need to start talking about homelessness, because people who are homeless are more likely to end up in Rikers, and they stay for much longer. So, as I said, in order to close Rikers, we need to get from 8,500 to 5,000 people. If we manage to do that, the city stands to save $520 million per year out of the Department of Corrections budget. However, it's kind of almost like the catch-22 of we can't save that money unless we get people out, which is we need investment in people to do. So it's kind of this circular argument, which is where a role for impact investing could be. Particularly, there is one group of people that I think is a particular interest to this group. They are people that cycle in and out of jails, shelters, and emergency rooms. They're essentially serving a life sentence a day at a time. It's really low-level offenses, but they're just doing this institutional circuit. And they cost us a significant amount of money. We know that housing works for this population. It gets them out of shelter, it gets them out of emergency rooms, and it gets them out of jail. And to make kind of clear how much of a cost saving this could be, if we could figure out how to structure a deal, it costs $82 per day to give someone a place to live, which is supportive housing with services. In comparison, it costs $300 per day to shelter someone, $450 to have them in jail, and somewhere in between $1,900 and $9,000 to have them in a hospital. So in terms of the cost savings, not only in terms of those cost savings, but also the $520 million we save per year from the DSU budget, this is both very lucrative and it's the right thing to do. So I just want to kind of lay that out. And I've been told also to speak a little bit about why we don't do this. So New York City has had one attempt at a social impact bond, and it's hard for me not to speak about it and kind of chuckle to myself, because it was just not the world's best structured idea.
Tell us how you really feel.
Okay, so we have something which has a dearth of research which shows if you give people who are very unwell a place to live, you can get them out of systems. Or we do what we did under the Bloomberg administration, where we say, I know what will get young people to stop the cycle of reincarceration with young people, teenagers. We'll give them cognitive behavioral therapy when they're in jail, and that will stop them from committing crimes. And as a result, that weirdly enough did not work. And as a result, social impact bonds, impact investing is kind of not in favor in this city. So it's kind of two very different things, but it's very difficult to bring in impact investing in New York City because people were so burnt by this not very well thought out, actually just not very well thought out. Not in my opinion, it just was not very well thought out deal, so.
Thank you so much. Hello, everyone. My name is Chloe Byrick. I am the senior project manager for a company called the Leela Gorin Group, and we are an impact investment firm and development firm in real estate. What does that mean? So we focus on adaptive reuse projects, all historical buildings, and we open up a new chapter in the story of these buildings' lifetime. Try to extend the story of this building's lifetime. The other thing that we do is focus only on projects that are a story of transformation. We flip the script. So Imogen, your work makes me think of a project that we've been working on called the Women's Building in Manhattan. Many of you may know it. It's on 20th Street, West Side Highway, and it was a former women's prison, not jail, and it closed during Hurricane Sandy, and we won the RFP to convert it from a women's prison into a women's building, a center for women's empowerment, a co-located center for nonprofits and women's-focused organizations. So that was a transformation from a place of incarceration to a place of liberation and empowerment. We're working on another project in Yonkers, which is a power plant. In this case, we're both investor and developer. And it used to be a coal-fired power plant in 1906. It was polluting. It actually powered Grand Central Station at the time. And it fell into dilapidation, and it's been this blight on the community. And we want to turn it into a beacon for the community, maintain the structure, maintain these beautiful 200-foot-tall smokestacks, but use it as a way to revitalize the culture of this place. It's in Yonkers. It's struggling economically. Oh.
Just a little closer to the mic.
Great. Is that better? Ah, hi, everyone. So the projects that we serve also, the end result is always to house community, where communities of people can gather. For the Women's Building, women and girls-focused organizations. For the power plant, we see that as a cultural hub that the city of Yonkers currently does not have. We are also working on a project with the company WeWork on an RFP in the Presidio of San Francisco, an old military base that we're converting or attempting to convert, should we win the RFP, into a mission-driven campus for social and environmental-focused organizations. So that's what we do on the development side. When we think about our environmental and social and governance impact, we try to target all three with our projects. The environmental, not just achieving LEED or WELL certification, but in the case of the power plant, thinking about longer-term resiliency. It's on the water. How are we going to protect against future flooding? How are we going to take this polluter and turn it into a purifier? We're in the brownfield cleanup program. We're cleaning up polluted soil from the history of its past use as a coal plant. Socially, all of our projects have an economic development focus. When we've been working on the Women's Building, a lot of it has been with formerly incarcerated women who not only have served as an advisory committee for us, guiding the development, the programming leading up to the development. We just had a block party this last week where women were able to share their vision for what happens in this space, but also as a way to provide people of that community who face barriers to employment with opportunities to work in the projects that we're developing. And in terms of governance, we're a woman-owned development company. It's not very typical, but when we have meetings with our architects and our contractors and our engineers, the room is all women. Looks a lot like this, actually. And but the women particularly who are of the generation older than me say, I've never experienced anything like this before. This is the only time, I'm not the only woman present. So there's a new model of leadership that we have. And that's a little bit about our work.
Hi, I'm Kristen Cook from Jonathan Rose Companies. Jonathan Rose Companies is a for-profit mission-based real estate investment and development firm specializing in green, affordable, and mixed-income housing in transit-oriented, high-demand urban markets in the U.S. The kind of concept of sustainable cities has really been part of our inherent core strategy and values since the firm's founding about 30 years ago. We are the 10th largest owner of affordable housing in the U.S., and last year we were the largest acquirer, or the number one acquirer of affordable housing in the U.S. Through our funds, we acquire existing affordable and mixed income housing in transit-oriented or walkable locations. We green them for environmental and economic performance improvements, and we connect our residents with social services to improve their lives and outcomes. We green our properties so that they perform to third-party standards like enterprise green communities criteria. We improve operational efficiencies, and our social service programming connects our residents with existing community programs around health education, arts, safety, food, etc. On our development side, we try to create new or improved models of affordable and mixed income housing, and we enhance those developments with community serving elements like schools, libraries, health service providers, community gardens, green space, etc. And our goal is to really make new models that are replicable and scalable to increase our overall impact.
Officially, good afternoon, everyone. I'm Derwin Sisnet. I am a managing partner at Rethink Community, which is a social impact investment fund that invests in real assets centered on healthcare, housing, workforce, and education. The context and I guess the background to all that is, while I know I look like I'm 12, about a decade ago when I still wasn't 12, I led an organization's efforts to develop a blighted area in Memphis, Tennessee. I'm actually a native New Yorker, but cut my teeth in real estate development in Memphis when I started a school. And when I started that school, I realized pretty quickly that that wasn't enough to turn around a neighborhood. And so I learned how to develop pretty much on the job and acquired about 24 acres of blight that was so bad all 394 apartment units were collectively appraised at $100. The land was valued at $1.6 million, so we went in and figured out how to acquire it as a lowly nonprofit. $1 million was a tax write-off, $400,000 went to the back taxes they owed. They were 3 years arrears in their taxes, and we had $200,000 left to pay, which we didn't have as a lowly nonprofit, so the city of Memphis gave that to us. We then built a network of charter schools to build the capacity to then do more work around that property, acquired another 18 acres of undeveloped land that was landlocked by that property, and in its place we put a performing arts center, which FEMA gave us money to do, believe it or not, $3.5 million to build a tornado shelter that doubles the performing arts center when there's not a tornado, and we built the middle school using New Markets tax credits, raised about $5 million in philanthropy, and then partnered with Habitat for Humanity to build affordable housing. And so all that allowed us to step back and say, well, now we've created this ecosystem. Oh, and by the way, we acquired the shopping plaza directly across the street, put a high school there next to a medical clinic and dental clinic that serves underinsured families. And so when we stepped back, we built this micro city, and the schools that we created became the highest performing schools in the entire state of Tennessee, and they were all public schools. And so that was the precipice and the thesis behind how we could do this from a social impact lens, because that all happened as a nonprofit. We were able to do that and build out an asset that's well worth over $25–30 million, and we put out $1 million altogether of our own money. The rest was a combination of philanthropy and public incentives. And so we stepped back and said, how do we do this at scale? How do we do this more quickly? And social impact was the way. The challenge with that, and as the earlier panel talked about opportunity zones, and maybe we'll get into that a little bit here, is that all of a sudden the opportunity zone hit. And everyone now is waiting to figure out how they could invest in opportunity zone funds. And what that means then for a social impact real estate fund is people are like, we want to invest, but let's wait and see. And that sort of steps back to the world I was in a nonprofit space where it's a wait and see and it's this long road. And so the challenge I have, and similar to the mindset around prison and prison reform, is if we're still thinking about it the old way, we're going to do it the old way and it's going to take forever and it's not going to be done well. And so the other hat that I wear is I run with my partner a nonprofit real estate development company that invests in the same sort of thing that I described a moment ago. And so while private equity is one way, we're also searching for other solutions that will think about this differently and not just an opportunity zone. Because what happens if it's not in an opportunity zone and it's not on the west side? What do you do with that? And so that is a challenge we have, but also encouraged by this panel, encouraged by a different type of diversity that's here, because the reality is, whether it's in the equity space or the development space, everyone looks the same, and but we're not serving people who look the same. And so it's important for us to have the conversation here, but then bring it outside of this room too. So excited to be here. Thank you.
Thank you. We have time for panel questions and then throw it open? Okay. I feel like there seems to be an opportunity zone buzz, and it feels like a little bit of a buzz kill. So I wanted to ask Chloe and Kristen if you are looking at opportunity zones and not necessarily raising a fund, but maybe doing projects, and maybe give us a little bit of a pep talk around that.
Sure. We're definitely looking at opportunity zones. It was sad when our projects, particularly the power plant, which is in a poor area of Yonkers, was not in an opportunity zone. And so we weren't able to reap the benefits there. But certainly it's something that we look for, but we don't acquire a huge number of properties. We don't have a fund. So it's something that we've been working to lobby ESD to select our parcel as an opportunity zone so that we could be part of the program.
We also are looking at opportunity zones, as is, I think, everybody. We get calls every day from investors looking to understand more, but we still think that there's not enough information out there. We're waiting for, definitive answers on tax reform and clarity there. We don't think that our fund structure is the best place for opportunity zones. We're looking at it more on our development side for one-off kind of deals that way. We think that it's a little premature for funds at this point.
Sorry, question? No? I'll just throw in something from the fund manager point of view. Community capital management is thinking of raising a fund with impact. And Lori mentioned the Kresge and Rockefeller LOI RFP earlier this year. And it was limited to 3 pages, which was a function, I think, of how many responses they were expecting. And we responded to that, and we're still part of the process. It seems to be taking a little while. But we have a 3-page definition of our 18 impact themes. So we couldn't really answer any of their questions because we already have a definition of impact. Most of the people that responded were, call them traditional or conventional fund managers, particularly in the real estate and real asset space, for whom the process is helping them articulate what impact means, if indeed they're going to have a concern about impact at all. So, we see it, whether we actually end up doing a fund or not, there's going to be a significant new channel or segment coming into our world, and some of us are very protective of our world because we've been doing it for a very long time. But it is really important if you are on the advocacy side of this business. Many of us are both practitioners and advocates. You want to be successful. You want a larger constituency. When you have a new constituency, we have to figure out how to speak their language in the hopes that they will be encouraged to learn to speak our language as well. In this current environment, politically and regulatory-wise, it's an open question as to how that will all work itself out. So I'm happy if folks in the room have things that haven't been discussed. Yes.
Ellen Riley, and I have so many stakeholders following me, accusing me of X, Y, and Z, but we're advocating a model for functional channels so that the functional expertise is at the community level, but ultimately it's nationally driven as well, so it's data. We're working more in tandem with our communities. The national stakeholders, so we'll have the data to do whatever we want across these 8,000 communities, right? So are we chipping away at it is what we want to make sure we get the macro detailed chip away success piece on it. But one of the things I've learned in my effort to convert over, if you will, is that the model we're going to use is debt only. So anything above the equity is not, it turns over back into the public good. So I think there may be a misnomer in myself and others. So I'm in agreement in the sustainable operations, But I think we may find there's another set of solutions beyond where we are that suggest the income above debt, which is where the equity piece is what the public good needs. So it's through restraint that we're going to be able to sustain what we want to accomplish in a joint effort. So I think we're so vested in the equity model of sustaining business, right, and bringing it into the impact investing. But I think there's actually a model of restraint in the middle that we're jumping past. And we may be able to jointly bring the standard business practices into that community objectives and meet both goals. So I just want to make sure, and I know the opportunity zone is not structured for that, but it was my surprise over the last, just in articulating something we didn't articulate because people were still